So, hello. Thank you all for coming out today. So this is my first time presenting to people. So this is cool. So I appreciate you having me. My name is James. I am the owner of EliteTraders, a full-time currency G10 trader. So yeah, that's basically it. We'll keep the intro short and sweet. So I started in television and transitioned over to finance. Why? Well, because the money was too slow. I wanted to have more control. I was living, paycheck to paycheck. Needed to find out, how do wealthy people make money work for them? We've all heard the saying, you need money to make money, but why and how? So I did research, and it turns out the S&P was a very typical and common way for people to start investing. But again, it was very slow. I was doing 4% a year, roughly. So I started again looking, how do I start making money? How do I do it faster? How do these institutions do it? How do rich people make money? And that led me into active trading. So from there, I decided to start trading, obviously adding money into a trading account, obviously losing a lot of money during that process, but we won't talk about that just yet. So while I was doing that, I was also doing freelance work. So I left my full-time job in television, moved over to doing freelance graphics design work, so I could essentially choose when I wanted to work. So I wasn't obligated to go into work or answer a boss or do anything. So I could focus on trading while still making relatively consistent money. So during this period, while I was trading and doing freelance, I was posting a lot on social media, doing a lot of analysis, trade ideas, trade results, that type of thing. And that led me to building a network. So I was meeting a lot of people, obviously online, talking to a lot of people. And eventually it led to me coming across a company called EliteTraders, which I pretty soon after decided to buy. So I bought out EliteTraders, which we can go into now. So this is my company's track record since 2017, which is when I decided to buy the company. So you can see our annualized risk-adjusted Sharpe ratio is 0.93. It's 2.29 if we don't do it risk-adjusted, but risk-adjusted is always better. On average, we are doing 34.5% a year ROI. Again, typically just trading G10 currencies. There's some commodities in there as well, which again, we can touch on shortly. So hypothetically, if someone joined in 2017 until last year, 2024, with $10,000 in a trading account, minus the monthly fees that we charge, which is normally $100 a month, give or take, they would end up last year with $174,000 in capital, which is what we aim for. We look to consistently and safely grow capital whilst also providing institutional grade research. So we are, again, significantly beating Barclays Currency Trading Index. We're also beating the S&P, which is a benchmark asset year over year, with relative ease. So these are the 2024 hedge fund returns. You can see this is pulled directly from Bloomberg. I'm not sure how well you guys can actually see this, but the way that we approach the markets at EliteTraders is following the macro strategy. So we're looking at macroeconomics. We're paying attention to what central bank policies there are, labor markets, GDP, that type of thing. So if we aggregate the average of all of the macro strategy funds, it comes out to around 27% off the top of my head. Now, EliteTraders beat the average, coming out at 32%. So again, outperforming basically the best of the best, which again is pretty impressive as far as I'm concerned. So in terms of professionalizing EliteTraders, when I took over, it was heavily tailored towards the retail community. It was essentially just an iPhone app, and it would send notifications when to buy and sell, and what to buy and sell, which of course goes into a territory of financial regulation on financial advice. So we had to sort of move away from that anyway. We hired specialists. So we worked with award-winning hedge fund managers. So yeah, essentially we did everything we could in terms of hiring people to come and bring as much of a professional aspect as we could for our retail clients. Again, we also brought in execution strategies. So it's not a case of just looking at charts and candlesticks and things, we try to dive as deep as we can into what's actually driving the markets. So we use high quality data sources rather than sitting on Google and Bloomberg News and things. We have specialized data providers that will give us information such as inflation data, central bank policies, news releases, and that helps us build trade theses and keep up to date with the markets. Sorry, give me a second. So again, building a diverse and specialized team, we hired the best that we could. Obviously, we're not a regulated institution, so we can't put job adverts out looking for people like that. I mean, we can't afford it, and also we can't do that. So we went on social media, almost like I did, and we find people with skill and talent, and we try to extract those people that have an institutional or professional background as much as we can. So again, award-winning hedge fund managers. One of the previous co-owners of EliteTraders worked at Deutsche Bank and Westpac Bank. We've also had traders that have gone on to start their own funds. And we currently have a trader on EliteTraders that owns a family office. He's Series 7 and Series 65 regulated in the US. So in terms of actually being elite, when we're trying to compete against institutions with hundreds of millions in capital or assets under management, how do we do it? Well, it's a case of trying to see what they see and removing the constraints that they have. So if you look at the way institutions work or large capital market participants, oftentimes they will have risk compliance that they have to listen to. They can't break certain rules. They will have portfolio managers, they will have clients, they'll have brokers. They have to communicate with so many different people. They have certain rules they can't break, which is very different for us. We operate how we want to, essentially, while still seeing the same things that they do. So we are data driven. So we'll look again, what is the data telling us to do? We're not going in to the market saying, oh, there's a certain level here. Let's go and buy or sell according to that. We're looking at if that level is hit, why would the market go up? Why would it go down? What's the probability of one of those situations happening? Institutional grade research. Again, we do have access to this. So every weekday we get reports from places like HSBC, ING, Credit Agricole, Bank of America, so on and so on. So that allows us to build their research into ours. So whether it's built on top of something we've already got, or whether it's a completely new idea that we didn't see, we've got it basically the day after they do. Flexible execution. Again, no constraints on what we do. So we don't have to hedge. We don't have to use a certain amount of risk. We don't have to necessarily tell clients what we're doing. We don't have a portfolio manager to tell what we're doing. We can just do it. If people don't like it, they don't have to follow along, but we do what we want to do. And that leads us to being very free and flexible in these markets. Continuous market tracking. Again, we have news sources. So we have real-time news flows. So no matter what happens within half a second to a second, we've got the news flow coming in, telling us what's going on. So if inflation came in higher, like it did yesterday for the US, CPI came in at 3%. It was forecasted at 2.9. So that type of thing allows us to adjust our positions, get in, get out, do what we need to do very, very quickly. And again, we don't have to tell anyone. So we are very free. In terms of tools and research, obviously we don't have access to things like Bloomberg Terminal. So we have to find other things. So we've got commitment of traders, also known as the COT reports. This is how we know what the institutions are doing. It's slightly delayed. So we get it, I think it's roughly a week after it's been updated by the institutions. But that tells us if we are looking to, for example, sell the euro, what are institutions doing? Are they heavily buying the euro? Because if they are, then that probably tells us we've gone wrong somewhere. We're not wanting to go against them because obviously they're the ones that are moving the markets. We can't fight that. Interest rate probabilities. Again, this is one of the key ways I trade. So if we've got a central bank divergence. So I'm not sure how well you guys can see it. In this image here, this is displaying the Swiss National Bank. So we can see they are expected to go into negative interest rates later this year. Now, if we compare that to something like the Bank of Japan, who are currently on a path to normalizing their rates, we have a divergence there. We've got the Swiss National Bank that's cutting rates. we've got the Bank of Japan that is slowly hiking rates. And that provides us an opportunity to start buying the yen and selling the Swiss. Seasonal trends, again, we can look at what the market does at certain times of the year historically. This doesn't really apply too much to FX in my opinion. I prefer to use that on currencies because when we have historical patterns, especially on commodities such as wheat, corn, coffee, we can see those weather patterns repeat, such as winter, summer, storms, those types of things. Real-time market monitoring. This goes back to what I was just talking about having news flows that update in real time, so we're never really behind. So again, if something happens, let's say a central bank hikes their rates far more than the markets were expecting, we will, of course, see a large market reaction. So rather than seeing that reaction on the charts and saying, oh God, what's just happened? We can see what's just happened and we can adjust accordingly. There's no surprises. Or there are surprises, but it's always manageable. Geopolitical events, of course, is a big one. So, for example, at the moment, there's currently talks about Trump amending the problems in Russia and Ukraine. So if that does happen, we will know as soon as that information is confirmed, and it's definitely happening. So if there's a risk off market or a risk on market, we know not to sell gold, we know not to buy gold, we know what to do in each situation according to what is happening in the markets at that time. So proprietary analysis and execution, it's probably not the best name because it's not proprietary. Everyone should know basically what this is. So this is using key levels. So we look at levels in the markets where prices previously respected. It's very basic stuff, but it's a great way to actually get into a trade after we've developed the idea. So we're looking for, this is Swiss yen. As I was just saying, I'm looking to buy the yen, sell the Swiss. So I'm looking to sell this market. We've got relatively overbought. We're coming up to a pretty strong or historically relevant key level. So if I'm already looking to short the market based on the economics and the central bank policy, this is probably a good place to start. So again, we start with the macroeconomics, then we move on to very basic technicals just to use as leverage into the markets to get in. So we can do two things because again, we don't have to pay attention to risk compliance. We don't really have any rules. If we want, we can just, sell the market and hold it till we're not happy, or we can get in, get out, get in, get out, and we can continue to sell off a downtrend, or we can continue to buy into a bullish market depending on what the situation is. So that allows us to yield very high results in a very short amount of time. Economic strategy and swing trading. So again, what I was referring to, we use macroeconomics first because this is what moves markets. So obviously if macroeconomics are not very good for a certain country, the perception will be bad. So that's what we're trading from essentially. So it's macroeconomics with a little bit of psychology, but anyway, focus on G10 currencies. That's my forte because with G10 currencies, they move very differently to things like stocks and commodities. So if we look even at other currency pairs, so something like the US dollar against the Turkish lira, or if we look at gold, any type of market really that's not G10, we will often see trends that run for months and months and maybe even years. I don't like that. I like to be able to be very diverse and very adaptive in the market. So if we see, for example, euro dollar has been moving to the downside for the past 4 months, that's fine because I can sell that market, no problem. But I know eventually that will revert because it's a very mean reverting pair or very mean reverting currency, just like all the other G10s. Whereas again, if we look at something that's not really the same, something like gold, it's very, very difficult to be on the wrong side of that market. So I like to always be able to hedge out or get out of the market if I am wrong. So yeah, trading G10s allows me to mitigate as much risk as possible. So we'll move on slightly to entrepreneurship, because obviously that's what I do. I'm not just a trader. I run a business. So business is rough. I'm not sure how many of you, does anyone want to start a business here? Raise your hands. Yeah. Okay, cool. So it's tough. Now, these aren't new. This is not new information. Everyone knows it's hard to start a business. Most businesses fail. But the problem is, it's the reality, because what you can hear me stand here and say business is hard. You can hear someone on TikTok say it's hard. But when you actually start, you'll realize why so many fail. So I am at my desk 10, 14, 15 hours a day, every day, Monday to Sunday. And it's not just dealing with clients. It's not just placing trades. There's paperwork, there's taxes, there's accounting, there's staff. There's all sorts of things that you won't think about until it comes. And then you're like, oh God, I didn't plan for that. So be aware. The next one is you trust no one, really. And that's not in a pessimistic way. What I mean by that is you need to have contracts in place. So if you are hiring someone, you're working with someone, even if you're bringing on a new client, you need to have a contract. Doesn't matter if it's a friend, family member, business is business. If you don't have a contract, you are at risk of being sued, being taken to court, refunds, all sorts of stuff start opening up that you might not want. So that contract will keep you safe, but obviously get it written by a professional. Don't write it yourself because it probably won't work. Due diligence, obviously, always look into who you're bringing onto your team or who you're hiring, whoever your client is. Always try to know who they are because, people can lie. It's very easy. Whereas, internet footprints last forever. Customers first. Of course, if you're doing a service or a product, your customers have to come first. If you do a bad service, they won't come back. Word of mouth spreads, they'll leave a bad review. Your whole business can be over by just treating 5, 10 clients poorly and them not being happy. So career opportunities in trading and finance, you have 3 main ones. I mean, there are obviously other options, but we'll talk about these 3 main ones for now. So we've got institutional routes. So you can go into research and become sort of an analyst. You could be a portfolio manager, or you could be a trader. Now, I'll be honest, if I was in your shoes, I would go down this route if I could go back in time. I didn't, unfortunately. But if you're wanting to build a network, you want to have those connections in finance that are pre-existing, and you want to earn pretty good money, institutional is the way, in my opinion. Startup or small boutique, like EliteTraders, it's less capital intensive, but it's a lot of work. It does allow flexibility. So again, it's my company, it's hard work, it's a lot of time, but I can take time off and, come here and do talks. I can go on holiday, take a day off. I don't answer to anyone. So that's a perk. But again, the amount of work and risk that I'm taking on, is it worth it to you? Retail trading is obviously the most flexible. You can trade, you can not trade, do whatever you want. But the problem is with retail trading is you need so much capital. You will need, I would say, anywhere between $200,000 to $500,000 to be able to survive of just an okay month. That's not accounting for break-even months, down years even. So the EliteTraders hiring criteria is very different. It's not like a typical job because we don't have a typical job. We aren't sat in an office. We don't have an office. We actually don't really have many staff either. But when we are hiring, we aren't looking for degrees. We're not looking for PhDs. We're not looking for necessarily institutional experience. We just need to see people that can do the job. So for example, if someone came to me and said that they want a job, I would ask them to show either proof of profitability. So I'd need to see some sort of trading history that shows that they are making money for the past 1.5 to 2 years. Or if they are coming on more of an analyst role, I would need them to put together some trade theses. It doesn't have to be current, it could be previous ones, but I would need to see what they're capable of, because I don't want to bring on people, put myself and my clients at risk by hiring someone that can't do the job, because there's lots of money involved in this career. And again, ability to explain market reasoning and risk approach. Although we don't have risk compliance, we can't just go and risk 20% of our capital on one trade idea, because that's, it's not safe. It's not a good idea. So we need someone that can explain why they're taking the trade and what type of risk they're taking and why they're taking their risk. For example, is it correlated with anything else? Do we have positions open that could affect that one? And finally, a Q&A. Is there any questions? I know it was relatively quick. I tried to make it comprehensive and streamlined, but if there is any questions, feel free to ask. If not, Mario will take over shortly after.
So, if you have any questions related to trading?
Yeah.
So you came from television, and how did you start trading? How did you form yourself with books?
Yeah, so I had a mentor. So I had a family friend that was working in Canary Wharf in London, which is the financial sector. So he would send me things. So, for example, he would say, the Bank of England has just cut their rates. What does that mean? What's the outcome going to be? Or how does that relate to inflation? So I would say that I don't know. I've got no idea. So he'd explain it. It wasn't like a proper mentorship. It wasn't like we sit down together and do things, but he would guide me and show me how economics work and what their impacts are in certain areas. But then it was my job to go and apply that to other things. How do I put that onto a chart? How do I make money from that idea? So yeah, that was basically it.
So,
yeah,
just a note on this. Look at those annual gains. If you know what the Sharpe, anyone knows what the Sharpe ratio is? How is it calculated? Okay. So let's start with that because so the Sharpe ratio is basically a measure in statistics that is used to evaluate portfolios. So when you are comparing portfolios, especially in high-risk investments like trading, you cannot just look at raw return because you might have a crazy trader and you might have a trader which is more experienced, and maybe the crazy trader makes 100% year over year, while the other one is more consistent but makes only 10% per year. So maybe you might be inclined to say, okay, maybe I can divide 50% to one and 50% to the others, but that's not enough. You need to evaluate not only the returns, but actually how much risk is that portfolio taking to produce that return. So one metric to calculate that is the Sharpe ratio, because it's very simple. It's basically the returns of the portfolio minus the risk-free rate divided by the standard deviation of those returns. So this how many? So this is calculating basically alpha, because, for example, for this example, since we are trading different currencies, the proxy that we have to approach risk is, or the alternative is investing in 3-month monetary markets. So basically short-term interest rates. So if those interest rates are at an historical average since the 2017 around 1.5% or 2% at most, that gives us a Sharpe ratio of 0.93. That means that, well, non-adjusted, that means that if we consider that for up until maybe 2020 when the COVID was and then interest rates rose and all that. So before that, interest rates were basically at zero. Okay, and short-term ones even negative. So then if we consider all the portfolio return as alpha, because there is no risk-free alternative, the only way to make money in this economy is to risk. So and you divide that by the standard deviation of the portfolio, that would mean that for every 2 points, so you would have for each unit of risk, for each unit of uncertainty, let's say, you have 2.29 more times returns over that. It means that, well, this is explained basically by this curve, which is major. So the thing, I tell you this because I'm going to try to bring you people related to trading, related to portfolio management, but I won't guarantee that we'll have another guy coming here that can have those amazing results. Because indeed, if you take time this afternoon to compare what's the average Sharpe ratio, what's the average annual return of a global macro strategy hedge fund or something similar, you will see that it's nowhere near those numbers, and most of those professionals are losing money year after year and charging fees for that. So I say this because you have a really huge opportunity here to, if you are at least trying to see how trading works, or you have traded for a year. Here now is the moment to ask specific questions. Like, don't hesitate to ask just general questions, but if you have a specific question about, I try to trade stocks using this or that, this guy here is like the most experienced person you will have for this type of thing. Although he might not have gone to finance and so on, he has a track record. He has managed a team. We have all learned from others, so it's the time to ask.
Relating to the research, Does the team have a perennial or seasonal model to offer?
Sorry, could you repeat that?
Related to research, does the team have a standardized model like perennial or seasonal for alpha? Or alpha
Nope,
seeking?
neither. So we are happy to basically trade however they are happy to trade. So for example, if someone came up to us, wanted a job, I don't really care what their approach is, as long as it's manageable from a overall risk. So we won't be taking, as I said earlier, we won't be taking 20% risk on the portfolio. We're happy to take 1 to 5%, depending on the quality of the trade, but that's about it. We don't really care how they came up with it or what their reasoning is, as long as it's solid and as long as we can sort of see why they want to do that.
Probably having here's a better pattern. I mean, generally, what your strategies are based are on seasonal timeframes, or is there some standardized approach to strategies?
What do you mean with seasonal strategies?
Well, perennial meaning if it's a strategy that holds up over time, or at least has some key points that stand out over long periods of time, or seasonal that will only apply to a specific context.
If you have kind of seasonal strategies, like
No,
commodities.
no. So I very rarely trade commodities. I will if there is an anomaly. So if there is I don't know, let's say there's a storm that will affect the supply of coffee, then yes, but it's not seasonal because it could happen at any time. In terms of FX, G10 currencies, no, because they don't really apply to seasonality or historical price movements too much. It can have an influence, but it's not something I would trade from.
I would say that the global macro strategy, which is basically for those that don't know, a global macro strategy is basically a discretionary strategy that hedge funds can use, which is basically based on understanding of the general economics, general macroeconomics, and finance aspects that move markets. Basically, what is the fundamental reason behind the market moves that we see every day? So this global macro strategy is generally traded discretionary, which means that although you can have models to inform your decision making, it's not like quantitative trading. It's more kind of a job that would benefit of having people, for example, experts in history or things like that, so as to interpret what is happening in the world and kind of make bets on those developments. So the thing that happens is that most of that trading of trying to predict, for example, political trends or things like that, happen in currencies. It just happens so that this is the best asset class to express those views. So to the question that you were made, I think that EliteTraders doesn't have kind of a seasonal strategy or changing strategies. It's like the same strategy over time. You build experience, you try to forecast what is happening around the world with the information you have and use that new interpretation, and then it's up to you to express those views.
I have a question. Right now that we are hearing kind of like valuables of the stock market, such as yesterday with the inflation and with all the things that is going on in USA with the tariff, what companies do you think that is really good to invest, and what companies can meet all these kind of problems?
It's a good question. It depends. So if you're looking to Europe, I think you would have to wait, obviously, to see what happens with those tariffs. Canada, I'd be looking at oil exports, any oil-related companies. China could be interesting, so I would look into AI in China because I think there's a problem arising with DeepSeek. So I think if China is trying to compete with the US in AI and general imports with obviously the tariffs as well, I think China could be an option. Other than that, I'm not 100% sure, to be honest. I'm not a huge stocks guy. I am, mainly just currencies. So unfortunately, I can't give you too much on that side. Sorry.
Yeah, anything related to currencies, politics, interest rates, things like that. So anything?
You told that EliteTraders focuses on the forex market, but when you start, have you some experience or have you worked in our markets like stocks, crypto?
No, it was just currencies. So yeah, I came into it with the S&P, but yeah, I looked at the stock markets. I tried to just look at the charts. I just saw gaps everywhere. It was a mess. I didn't understand at all. So yeah, I just moved straight to currencies, and that's been it. So yeah, always been G10 currencies.
Would you recommend to someone that is now starting in trading to get directly into the forex market? Do you think it is the best option?
Yes and no. It depends on you, really. It depends what you like to do. So, for example, to trade forex and currencies, you need to be aware of the macroeconomics. You can't just go in sort of half-hearted and give it a go. Whereas crypto, I think, is a bit more casual. You know, you can sort of just invest in Bitcoin and let it go. Stocks, again, I'm not too experienced with stocks. Commodities, though, again, it would be more dependent on weather patterns and how oil refineries, oil reserves looking and things. But I would suggest, or I would say that currency is probably the easiest way, just because you can focus on, for example, the euro against the pound or the dollar. And because you live in Europe, you can kind of get a feel for how the euro is feeling, how's inflation affecting you, and trading based on your experience, not just what data is saying. So, for example, the situation in the UK is really bad. People are struggling. There's teachers and nurses going to food banks because they can't afford to go shopping. So I used that to start building an idea to go short on the sterling or the pound. And I've been making money off that since November last year. So it's your feeling of the economy, not just what data says. So yeah, I think currency is a great idea. Yeah, no problem. Yeah.
Do you think that having an advanced mathematical knowledge is important?
No. I'll be honest, I failed maths. I've been failing maths since I was probably 13. I didn't do maths at all. It doesn't really apply. The only maths I do is on a calculator to find out my average entry price. And that's it. I think there's obviously other options. You want to be a quant or you want to go into analysis, then yes, possibly. But to do what I do, there's no maths. I'd say it's important. I think obviously maths is always important. But yeah, to do what I do it's not needed.
I would say it depends on the strategy you trade, you focus on. Because here we are talking specifically about global macro or event driven, which is basically event driven, or you just have to research what is happening around the world and kind of forecast what will be those effects without using complicated economic models. That doesn't mean that you would benefit from having that math knowledge or knowledge of how to build models, how to program, whatever, to provide you kind of an advantage on that. But still, for this specific strategy, it's not really necessary. For example, as I am aware, there is hiring for hedge funds on global macro that specifically target PhDs in history. People that are kind of really passionate about history, and the only option when you are passionate about history is teaching to others, because there is no added value to that, or maybe researching. So what happens is that then there is a fund that comes to you and sees that with your research, your knowledge, they can make a lot of money, so they can pay you. That's the route that many experts in history take, which is go and trade or go and research, well not go and research for global macro strategies, hedge funds. Because they have this kind of advantage that when you are very seasoned in something, like for example, consultants. When you go to the Big Four, there's people that are engineers, there's people that you focus so much in an area that you are useful to other people in ways that you never imagined. So for this strategy, you're not that good at math. It's basically trying to do, forecast what is happening around the world and present those views on very long term.
Yeah.
How much capital is you start?
I had £8,000. That was my starting amount. So that was inheritance from a family member. Then I lost all of that in about 24 hours on Dow Jones. And then I started from nothing. So I was putting in maybe £100 a month on top of bonuses or overtime, whatever else I could get. So it was just always, any money I had went back into trading. So yeah, basically started from about £1,000. That was when I started taking it seriously.
Before starting anything.
Yeah. Before starting with traders.
So in EliteTraders, you manage your clients' capital?
No, not directly because we aren't regulated. So we essentially tell them what we're doing. We provide research. So we'll, for example, we'll provide a research paper on why euro dollar might be going to the downside. Then we'll say, this is how we are going to take this trade. We might be selling at this level. Feel free to do the same. And that's it. So we just share what we do. But yeah, we can't take on capital. Yeah. I think if you can get regulated and take capital on, there's a large amount of money to be made, because obviously you can do performance fees and management fees. And that's obviously when you become more of an investment fund, or a hedge fund. But yeah, I think the simple way is just to basically tell other people what you're doing.
In fact, many large businesses in the UK finance are exactly this, are what it's called signal boutiques, which are small firms with some trader guys that are not regulated and provide basically the signals to those big hedge funds that you see, for example, in your bank account when you want to contract a fund and invest maybe 1,000, 10,000. It's a complex one. It's not just investing in notes or investing in the S&P 500. It's a complex strategy, discussional one. Sometimes the institution where you are buying where you are putting your money to invest is not really trading that money. They are just kind of the bank that is taking or copying the trades that those small research boutiques are sending. So you are basically managing a hedge fund without the constraints of having to actually manage capital. Upside, like as I say, you can be a losing trader or having a losing fund, and if you are a good seller, you're basically managing millions, like hundreds of millions in capital and charging 2% fees, fixed no matter how much money you. That's why that it's kind of a scam, but here it's like there is no trap. You are a good boutique and you provide good research. Retail clients, professional clients, everyone will get back to you to get back from you and copy.
Would you go over in depth about the analyst role in terms of how is the role recognized at the firm, or how is it compensated?
Yeah. So, the compensation really depends. So because we aren't a typical job, we don't normally give a salary. It's not a case of we will pay you 5,000 a month and you do this. It'll be a case of we might pay you 2,000, but you get 5% equity in the company. So if you provide good research, it brings on more clients, then you will earn more from your hard work as well, which is what we normally do. We're quite happy to give out small bits of our company to obviously pay back our staff. In terms of being an analyst though, it comes in great ways. So we're very active with clients. We don't just send them a paper and that's it. We will often talk to them. We'll discuss ideas. We'll teach them how something might work. That's where our analysts come in. They will be the ones that will help. So for example, if we have a client that says, you spoke about the central bank divergence, but what is that? Then we'll have an analyst come and talk to the clients about that and what that means and how we can execute around it. Whereas our traders are the ones that just talk about the trades. And obviously the analysts do the detailed advanced things.